Hi, this is Mohammed Akram. We are here today to conduct a webinar valuing illiquid investments. I have a distinguished guest here, Michael. He will make an intro in a bit, but before we go for intro, just want to give you housekeeping items that attendees will get the CPE certificate if they will answer 3 out of 4 questions. It's a 50-minute broadcast, and we want you to make sure you're listening the conversation. I think let's go, Michael. Please make an intro.
Yeah, absolutely. Thanks, Mohammed. I'm Michael Mascarelli. I'm a senior associate with Houlihan Capital's valuation practice. We're a valuation firm, part investment bank, part valuation firm, specializing in a whole lot of different portfolio valuations, fairness opinions, lots of different stuff under that heading. So happy to be here.
Awesome. Thank you. I'm the founder of Akram Insurance Advisory and Tax Firm, and we provide audit, tax, and consulting services to hedge funds, private equity, venture capital, and family offices. My other speaker are Steve and Hamza are busy on doing some audit work, so they asked me not to show up. I said, that's perfectly fine. More time for Michael. He would love that. Yes?
Yeah, absolutely.
Okay. So today we will cover the different topics. Main is how to value level 3 investments under FAS 157, ASC 820. Don't want to be very technical, but we will cover what main valuation approaches the third-party firm like Michael firms use, and what are the inputs, and how we do level 1, level 2, level 3 different hierarchy. And the other important part is that this is a different regime change. Interest rates were ridiculously low, money was cheap, Fed was printing money a year ago. Now everything is changed. So all these macro factors, how they would affect the valuation, what we do. So Michael will cover most of the things as a third-party valuation firm, as a valuation analyst. My contribution would be more from accounting, audit purposes, and sometimes tax purposes too, right? So to guide you that how to navigate those projects, and then at the end we will discuss the best practices for the valuation engagements. We have a screen for that. So go ahead, Michael, please start. Floor is yours.
Thanks, Mohammed. Yeah, as we mentioned, we're going to dig in a little bit to the how of valuing illiquid investments, but before we get to that, and we'll make it brief, we won't bore you too much, but we have to talk about the why. And the why in this case is fair value standard under ASC 820. The definition there, I can read it to you. It won't mean a whole lot. It's pretty broad, right? So the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants at the measurement date. So that is a whole lot of gibberish. There's a few things in there though that are really important. So fair value, it's an exit price. It's not an entry price. That's sort of self-explanatory in its own right. Fair value is a market-based measurement. It assumes a change of control transaction. It's not entity specific. So when you're doing a fair value analysis, you have to look at it from this market participant perspective. You have to understand that this value is being assigned in a broader marketplace. So it assumes a transaction in a principal market, or alternatively the most advantageous market. This is important when you're looking at assets maybe that are listed on multiple exchanges. You sort of are giving the exit the benefit of the doubt that it happens in the place where the value would be maximized. So that is, it's an important consideration, doesn't always get mentioned, so leaving that in there. And as previously mentioned, market participant assumptions. Inputs are on the basis of the fair value hierarchy. That's level 1, level 2, level 3, and we'll discuss those in a minute because they're extremely important. But the ASC 820 standard, it requires that positions are marked to market. That's for hedge funds, private equity, mutual funds. Can't hold at cost forever, as much as we all love to hold things at cost. And of course, there's significant disclosure required, a lot of citation for where inputs come from, as well as, again, citing that fair value hierarchy that we'll dig into momentarily.
So, Michael, one thing is that these obviously there's a price available for level 1 and level 2, right? So you third-party valuation firm can't contribute a lot to value those investments. And you think you have a experience in making some adjustments to level 1, level 2 securities because there's some price mechanism exists in the
Certainly.
market?
Yeah, I mean, so there's occasions where a third-party firm does make sense. You may have what appears to be a level 1 quote. For instance, we see this a lot with securities that trade over the counter, where you have a quote from an exchange, but the order book is extremely thin. And it's unlikely that the quote that you see is exactly representative of fair value. In that case, frequently it makes sense to reach out to a third-party firm, kind of get their take on it, see whether you want to proceed with a couple adjustments to that value. And then on level 2, a lot of the time we're talking broker quotes. And the difficulty there is a broker quote may not have sort of a requirement that the broker transact at that quote, in which case it's not always reliable as an indication of fair value. And you may want to either, hire a firm to make some adjustments or seek multiple quotes from multiple brokers to try to get sort of better triangulation of fair value. So I think there is this thinking that, level 3 is really the only time where you'd need a third-party valuation firm, and that's not always the case.
Oh, that was a great answer. Thank you, Michael. One thing I would like to ask you for a thinly traded security, as you said, it could be level 1. Do you give some kind of discount over there, the haircut, and what US GAAP requires you to do that after ASC 820?
Yeah, it's typically some sort of liquidity discount where you would consider that, although that's the traded price, you wouldn't actually be able to transact at that price and at a reasonable volume. So that's usually what the discount would consist of in that sort of scenario. But if you do have a level 1 quote and there is sufficient liquidity, then typically, yeah, there's really no point for us to step in. But that would generally be where we would approach it.
Mostly this, I think, is for thinly traded securities, if you need to make up.
Precisely, yes.
Okay, so here, can you tell us what board responsibilities or fund manager their responsibilities when they're valuing their investments on their books?
Yeah, absolutely. So the key thing here is that it's non-delegable. The buck stops at the board. They, of course, as many of you are familiar, may have an internal valuation team, may appoint others to really assist in these fair value determinations, especially larger funds with larger portfolios. This is an in-house process, takes a lot of different hands. So of course they can appoint some people, but at the end of the day, it's the duty of the board to ensure that this process is undertaken. Key points: they should have specific policies and procedures in place. This is major. This is actually something that many firms, including our own, are willing to help with on a consultative basis because it's so important to your evaluation process that it's on paper, that you know how frequently you review positions, how you review positions. It's very, very important. You should be aware of what requires a fair value determination. Frequently, that's a good question for your accountants or your third-party valuation firm. You should determine methodologies. This can be a back and forth at times. We'll get into it in a moment, but there's a lot of methodologies to choose from, a lot of different scenarios where those methodologies may or may not be applicable. So that's an important part of this whole process. And then, of course, resolving conflicts of interest. Frequently, hiring a third-party valuation firm is the step to do that, right? It's tough to both mark your own positions and then be compensated on movements in your own positions. So it can be full of conflict, and there are definitely ways to mitigate it. Yeah, we mentioned appointing a valuation committee to implement that policies and procedures document. That's very important. and then maintaining general oversight, making sure you understand what's going on in your valuation process throughout the whole phase, making sure you have kind of the reins on it.
Right. So that's a good topic to discuss regarding the frequency of valuation. That we usually require that they should go for a third-party valuation independently once a year, and we recommend them to value quarterly by the internal valuation team. There should be a separate valuation committee who should be doing that, but at least they should go for at least outside third party once a year, and probably would be better at the year end when fund auditors are doing the audit work. Is this what you see most on your side, Michael, or you people go more frequent, more than a year?
Yeah, frequently we do see that where, where this is a pretty burdensome process, especially for some smaller firms. Typically they'll seek third-party help at year end. And then they can sometimes manage quarter to quarter on their own. Ideally, again, because purely from a continuity standpoint, if you have your positions being reviewed on a quarterly basis, by time year end rolls around, your third-party valuation firm's familiar with your positions, they understand the changes in the business, and they can see the full spectrum of incremental change. So oftentimes it becomes a smoother process when you're touching base more frequently. But yeah, typically we see it at minimum annually.
Okay. One thing I would like to mention is that there's a difference between valuation and calculation, right? And most of the time, what we feel like, if the fund manager doesn't know, they're not being communicated properly. Sometimes they're doing a lower, just like auditors can do the full audit with the reasonable assurance, I can do the review engagement with a less responsibility and the negative assurance. So do you guys do both valuation and the calculation, or you do mostly the valuation, and what are the differences? It's good for
yeah, I mean, so a full valuation analysis is going to have considerations of both industry and economic considerations. It's going to be a pretty intensive process to try to get to a fair value determination. There is sort of a service offering that we provide and many firms provide on the positive assurance side, where you may do your quarterly evaluations in-house, and what you want is just a third-party firm to come in and just review your methodology, review your inputs, and sign off and say, in general, as we see valuation practice, this approach makes sense. There's no massive red flags that we could take issue with. So that's sort of the positive assurance side of things. It's not the same, as you mentioned, as a full valuation analysis. We wouldn't be performing the analysis as much as we'd be checking the analysis. So there is a range of service there, especially if you're not seeing massive changes in your industry or in the market of your portfolio. Positive assurance is sometimes a good choice. It's a good solution, and it helps you have, again, removing that conflict of interest, having a third party sort of vet your valuation approaches.
But just I don't want to put the dollars amount, but usually, typically, what's the industry practice cost wise? How much 20, 30, 50% lower cost for the calc versus full valuation?
It's situationally pretty dependent. I would say about at least 50% less. Again, just purely from a time standpoint, you think of it in terms of hours. It's a little bit lighter. But in the event you had to, defend an analysis, you don't have the same level of detail. So that's really where the discount comes in.
Awesome. So these are the valuation policies and procedures every fund manager should consider. Can you explain a bit, Michael?
Yeah, absolutely. The key here is consistency. Valuations on a regular recurring basis are not very helpful if they're not comparable. So consistency is key, as they always say. You want to clearly indicate in your document the regularity of your valuation process. Is it quarterly? Is it going to be annual with some stops in between? And you want to outline not only that regularity, but what that regularity consists of, right? What do your internal valuation people do as far as their review process? And it's important to note, if it's something you know is going to be difficult to price, it can be difficult to write a policy for how you're going to price it. And so that can come to the forefront as well when you're thinking about working with a third-party valuation firm. Sometimes you need someone to give you the language for how you're even going to approach these things. And they should be living documents. They should be reviewed. They should be updated. Situations change. Mohammed, as you pointed out, we're in a very different environment than we were even a year or two ago. It might make sense to update your policies and procedures to reflect that. Having a sort of removed committee that's addressing valuation difficulties, again, conflicts of interest, whatever you can do to mitigate those, extremely important. And then your policy and procedures document is a starting point for the SEC. So you want it as buttoned up, as reasonably frequently reviewed as possible. This is your go-to when there are valuation questions at your firm.
So I believe, Michael, it's a probably very common practice for auditors to call you and discuss if you are doing the valuation as a third-party valuation firm. But how frequent you have experienced, or your firm has experienced, that SEC examiners are reaching out to you and asking about the valuation you have done?
For us, it's pretty rare. It's usually if the SEC comes knocking, your analysis may not have gone so well. We don't usually interact with the SEC that frequently. But as far as having clients come and want to discuss their policies and procedures, we have actually had that happen a lot more often than I think historically, mostly because we've built a little niche for ourselves in the crypto space. And as you're probably aware, it's extremely difficult to price a lot of crypto assets. And there wasn't an existing format. There really wasn't a document out there that you could copy and paste and change the name on that would work for a crypto fund for policies and procedures. So that's kind of a point where frequently it would make sense for a firm with a specialty in the industry to step in.
No, we recently were involved. We have signed the NDA, non-disclosure agreement, so I can't tell a lot. We were recently involved with the M&A transaction, and we were on the seller side. Transaction has been closed, but we are not legally allowed to disclose anyone what the transaction was, but that was, I think, around $100 million transaction. It was the second largest digital asset company after Coinbase in the US were involved in that transaction. So hopefully things will change for the digital asset space, because they're going through a tough winter, right, because of the interest rates. So as soon as interest rates will normalize, these growth companies and these digital assets will fly again. Okay, let's discuss some best practices in that space, right? And also give me an incidence when you think that third-party valuation won't be independent. In what facts and circumstances? Give me an example that it won't be independent. Go ahead.
Sure. One of those that happens pretty frequently, you may have be working with an accounting firm that has a valuation practice built into their firm. They might be performing an audit and they're conflicted out, right? They can't do both of those, valuation work and the audit. That's probably the most common one we see in our space more than anything. It's usually these larger firms have both capabilities. One of them gets conflicted out. Best practices wise, well, we'll sort of skim through these because we've mentioned a lot of them. Your policies and procedures document should be as buttoned up as can be, reasonably regularly reviewed, should have good internal systems for monitoring information from fund holdings as it comes in, making sure that's conveyed to both your internal valuation team and a third-party valuation team if you have one. An internal pricing committee we mentioned, an advisory board we've mentioned, continuous investment monitoring, any developments at all. As a valuation provider, you want to hold on to those and convey them to us. We will really appreciate it. That's a big thing with information availability, especially with early stage companies where their communications may not be as robust as later stage companies. So anything you get, you want to make sure you're hanging on to it and making sure it's conveyed to your valuation provider when you get to that point. And again, appointing an independent valuation provider, great way to mitigate some of the conflicts of interest we discussed.
Awesome. So after 20 minutes, this will be the first polling questions. Let me launch this polling question. Okay, majority of the people choose A. I think A and C both are probably right here, but I think let's jump to the next one. Next game. So why is valuation important? This is more in the context of venture capital private equity funds, right? So can you please shed some light, Michael, on this?
Yeah, absolutely. It comes down frequently to compensation. If you sort of overstate value, you overstate potential gains. Performance and management fees can be wrong. At the end of the day, typically this can result in some litigation and all sorts of things. So again, because of that existing conflict of interest for funds, valuation is extremely important. That's really what it comes down to. There's tons of lines on here, but that's the end all be all for it.
One thing, Michael, I would ask here that we have seen certain venture capital funds, small emerging managers. If you are operating from California or state of Washington, we have multiple from there, and they have to follow their VC rules from those states. And sometimes those states don't require an audit. And for the VC funds, if you are managing less than reasonable threshold. And what I would have noticed that we have found two types of extremes. One is they will always like to overvalue, and in some cases, some fund manager would like to do no valuation. They will maintain at cost. And under the US GAAP and ASC FAS 157 and ASC 820, you can't do anymore. You have to have fair value every quarter, every year end to reflect the true capital balance. And one of the reasons we find some legal, some audit issues too, people would say, okay, even if I'm increasing the value too much, this is not a reasonable value. I'm not getting paid unless I sold this investment crystallization happens by we're asking. But my answer in those circumstances is that you may not getting an incentive fee though, but you may be getting a management fee higher. Depends upon if it's open-end fund, because if it's a closed-end fund, then you're going to charge management fee on the committed capital, and that will not change a lot, right? But in other circumstances, management fee, incentive fee role will play, and you need to be very careful that your fund documents are very well written, very well and followed. You're following all the best practices, and try to avoid those issues in advance before you launch the fund. Anything you would like to add here, Michael, in this, if we miss anything?
No, I think you touched on it. And one of the things you did mention is sort of the, going through an audit as a fund. Frequently, it's helpful to have a third-party advisor because they work with auditors so often and understand, the questions that an auditor might ask on evaluation, understand the workflow, the back and forth, So just sort of highlighting that's one of the things we see very often with fund clients is going through an audit process. We're brought in to help answer a lot of the questions that might be difficult to answer without a third party having done the valuations.
Let's go to the next screen. So yeah, so somehow we didn't discuss earlier these level 1, level 2, level 3, but we gave a overall view. Now attendees will learn more the technical jargons here from Michael. Go ahead, please.
For sure. Yeah, we can dig a little deeper. We sort of skimmed over these earlier. Your level 1 inputs, these are all fair value inputs. And there is, of course, a hierarchy. When you start a valuation and you're given all this information, all these inputs, you're sort of required to rank their relevancy based on level, right? So you may have level 1 inputs, which are quoted prices in active markets for identical assets. This is publicly traded common stock, where you can point to a market and you can say, this is the price. In that case, as we mentioned, there's really no reason to have a third-party valuation. That's the price. Of course, understanding, sufficient order book. It's sort of a key terminology here is active market. You want to make sure there are trades happening, it's changing hands. Can't be a trade from 9 months, 15 months ago. That's not as good as a level 1 input. Level 2 inputs, generally the way we see these, they're frequently broker quotes. They're observable, directly or indirectly as of the measurement date, but they're not to the level of a quoted price in level 1. So level 2 kind of splits that difference between level 1 and level 3. And then level 3 inputs are completely unobservable. This is where you really start to launch into the modeling of things. Something like a cost of capital is like a level 3 input. You really have to sort of come up with that. It's not observable. And you can see that last paragraph. Typically, if it's not publicly traded stock, it's going to involve some level 3 inputs.
So here is my question: is obviously it's very easy sometimes to determine level 1 and level 3, but sometimes level 2 could be tricky, right? It could be level 1, it could be level 2, and what would go usually if we see overall type of assets, as you said, common stocks, futures, options, traded options will be considered level 1. In level 2, and could be some bonds from the broker codes, right, as you are mentioning, but what would the digital assets, right? They should come under level 2, like all the altcoin and the Bitcoin, because the pricing is different in different exchanges. What's the logic for valuation firms and auditors to put digital assets under level 2, other than the stable coin? Stable coin can be level 1, but all the other they sometimes consider level 2, not as level 1. What's the logic behind?
Yeah, I think it's partially that pricing in that space isn't as established, and then as you mentioned, there's often disagreement between different exchanges, or something you can sometimes see in crypto is it's difficult to parse out whether the transactions are truly arm's length. Like if it could be effectively a wash trade and you'd have to go through the blockchain to actually trace whether those price movements are real between unaffiliated third parties. So there's definitely some complication there that you don't necessarily see with more traditional assets.
What about the stable coins? You think it's okay to value level 1?
That's a tougher one, and I'm not sure what the guidance says on stable coins, but as far as my thinking on it, generally it's that same process as you would with something like OTC common stock, where you want to really ensure that the prices you're seeing are as reliable as possible. You want to check multiple exchanges. Yeah, that's a tough one. I'm not sure on that one.
Right, but do you not think they will all be valued at 1? So it means most of the stable coins will be valued at 1, right? Like the USDC, right? So,
right.
But how, if someone is taking a position for level 2, what is the logic behind
I think frequently it's, again, seeing that disagreement where, because it's not really, yeah, it's a tough one. I mean, frequently I think that's more of a push against just that it's not a traditional asset than anything else. Yeah, so that's a tough one. I'm not really.
Okay.
Yeah.
Sorry to put you on the spot. I thought that
I gotta go back and think about it now. Yeah, got it.
right. Okay. Awesome. Let me see if there's any questions. So far it has been submitted. Okay, so let's continue the conversation. So this is more like level 1 in detail, if you want.
Sure. Yeah, and we can, again, we've touched on these pretty good. Yeah, unadjusted quoted prices, so no adjustments for marketability, straight from an exchange or broker dealer, deemed to be active. Again, that's key terminology. Consistent approach how the quoted price is used, that's part of your policies procedures. No adjustments due to blockage discounts due to size. This is part of that liquid active market where you need to be able to trade and you can't make an adjustment for blockage on the fair value. So that's something that does come up from time to time. And in a level 1 situation, there's no adjustment there. Again, you're assuming an exit price, so bid quotes are preferred. And once you make any adjustment, then you're in the level 2 territory.
But I believe if you have a short position, then probably you would take ask price, right? If it's another long position.
Right. Yeah. If you're going, yeah, if you're going the other way.
Okay. Awesome. Yes, please, level 2.
Yeah, and this is kind of the gray area between the two. So you might see quoted prices for similar assets that are not directly identical. Broker quotes, if the trade can be executed, again, it's important to note with a broker quote is whether it can be executed or whether the broker is saying that they will execute it at that price should you make that decision. So that is a key delineation on broker quotes. If they're saying that they think it could be at that price, that kind of strays into level 3 territory, kind of light level 2. Yeah, corroborated by observable market data through correlation or regression. This is that likely correlated assets concept where you have things that are extremely, extremely close and they've moved in such a way, and you can kind of point to their movement and say, logically, the thing we're looking at should move similarly in the market. Yeah, no proprietary modeling for level 2. It must be widely accepted, widely used analysis. This is frequently the case for a lot of valuation approaches, that there are certain techniques that are more commonly used than others. So it's important to know whether you're inventing a novel approach or not. And again, any adjustment to level 2, that bumps them into level 3.
Okay.
And yeah, level 3, sorry, go ahead.
No, please. This is your area of domain, right? Everyone needs your help for this level 3.
Yeah, and level 3 is that mark to model instead of playing on mark to market. It's mark to model. Unobservable inputs, as I mentioned before, required rates of returns, pricing multiples, considerations of fair yields. Models that we use, we'll get into methodologies momentarily, but Black-Scholes, DCF, market multiples of EBITDA, revenue. These are, adjustments to multiples that are observable, but the chosen multiple is not. So hence the unobservable thing there. As I mentioned before, publicly listed securities with very little market activity can fall into level 3. It's not actually that unheard of. It can definitely happen. So every once in a while, you'll see something, you're going through your Cap IQ and you'll see a stock and it just hasn't traded in 9 months. So that's going to get into level 3 territory most likely.
Do you not think if that is the case, stock exchange will delist that company? Right? There will be some.
Think, yeah, it's typically OTCs where you see that. But yes, you're definitely talking delisting at that point. Sometimes you kind of catch right before they hit that delisting, and it can be dependent, highly situational. Yeah, and cannot ignore reasonably available information. That's just sort of the broad scope of it. When you get to level 3, is just you need to get as much market info as possible to help inform it.
Awesome. Thank you. Let's continue our journey. These are the different approaches, and this is we were discussing earlier before the webinar that which approach should be used in a different facts and circumstances. So please go ahead.
Sure. Yeah. And actually, do you want to just skip to the next slide? I think we have a breakout of kind of some different. Oh no, that's okay. Sorry, you can go back. I couldn't remember the order here. Yeah. So it's really three approaches in valuation practice. They're kind of the three big headings you can work off of. You've got the market approach. A lot of folks in the VC private equity space will be familiar using comparable market multiples, enterprise value to revenue, price to book, relatively rare, but enterprise value to revenue, enterprise value to EBITDA, using publicly traded company multiples and applying them to a private company or another analysis under that sort of structure. Comparable transactions, same approach, except you're using closed controlling transactions to derive multiples and then apply them to your subject company. Previous transaction of the subject company's stock. This is a big one in venture capital. If you're having frequent funding rounds, it makes a lot of sense for something illiquid to point to the last funding round. If it's within a reasonable amount of time and there's no major developments in the marketplace that you would expect that the price would have changed, and you can kind of point to it and say, this is the most reasonable price. This round closed, people paid this price. They were, importantly, they were third-party investors paying the price, which we'll get into a little later. And then a firm offer, which is sort of getting close to previous transaction territory, something where maybe an LOI is signed and there's strong indication that the transaction is going to close. You can sometimes rely on that. Again, like anything else, it's a lot of understanding the situation extremely deeply before you rely on that. But that is a possibility. Income approach, this is discounted cash flow. Valuation folks love these because they're super detailed, lots of number crunching, lot of different subjective and objective assumptions in the inputs. So that's used pretty frequently, and we'll talk about situationally where that comes up. Capitalization of earnings is taking like a steady state cash flow and just capitalizing it into the future. That one is very situational, sort of an old school stock valuation approach, but it still has its purposes here and there. And then the cost approach. This is used in two sort of specific scenarios, which again, we'll touch on in a moment, but you can talk about your investment cost, sort of how much have you spent so far on a project. That can sometimes be a reasonable indicator. Cost to build, a sort of cost to recreate or a replacement cost, as well as a wind down dissolution of assets sort of approach there. So that's cost approach is used less frequently, but it's particularly appropriate for certain circumstances. Yeah, we've touched on a lot of this sort of by talking about other things, so we'll kind of skim real quick, try to get on to the good stuff. Methodologies, you want to consider the source of the prices, priority of sources, how the sources are used. You really want to make sure any information that's coming in as a valuation specialist is as vetted as can be, that you understand the context of the information, where it's coming from, what it conveys. And that will really help you choose your methodology. And then, yeah, again, as much as you can include readily available quotes from third parties to work off of in your methodology. Again, sort of thinking back to that ranking of inputs, as close to level one as you can get. You usually want to work from there rather than starting from scratch.
Again, these are more like, I think, brief overall summary of everything. I don't think so in this hour we can go in detail about any of those models, or like the option-based model, Black-Scholes, or like.
Yeah, absolutely. Yeah, there's a lot to dive into there, so we'll move quick through this. But again, you can kind of see where, when I mentioned that they're situational, it's highly dependent on what you're valuing, in what market you're valuing it, in what situation you're valuing it, and frequently what information is available. That's extremely important. If you have sort of qualitative information and just a revenue number, you're not going to do a DCF. That's just not going to happen. So again, you can see common equity, you've got everything on the table. Preferred equity and convertible preferred, we won't touch on it here, but you'll frequently see some difference between how a valuation specialist would approach valuing preferred equity versus a more traditional current value or common equivalent method. This is sort of a way that we use an option pricing method to parse out some of the additional value that comes from having a liquidity preference and having some downside protection. But that's a whole nother topic we can get into. But you'll see that if you're working with a third party that they may defer to that versus a current value method, but highly situational. Fixed income models, we use spread-based models, option-based models, a lot of convertible fixed income instruments. You can sort of price in the conversion option and then price the debt portion as normal debt. Recovery value as well, we sort of touched on that. And then your considerations for discounts of lack of control, discounts for lack of marketability, also situational, and they do come up from time to time, but it sort of depends.
Do they allow blockage discounts under US GAAP, or there's some limitations to that?
There are limitations on blockage discounts. I can't particularly remember the exact specifics, but yeah, blockage discounts are a point of contention in the valuation world for sure.
Right. Okay. Awesome. So this is again, I think the best practices we need to follow for that, right? Main is that it should be independent, and obviously firms have the expertise, right? Even when people want auditing firms to audit venture capital funds, they should look into the auditing firms who specialize in that versus any auditor from the 500,000 CPA firms, right? The same rule will apply for the valuation firms too, right, Michael? If you are having experience in cannabis or digital assets or any other software, you should look into the companies who are doing the most of the work, right? What is your response to these questions?
Yeah, I mean, all of these are good considerations, right? We don't have to sit here and read through them. They're pretty straightforward. But as you mentioned, industry and asset class specialization, or at least experience, extremely important in a valuation context. You have to understand what you're valuing, how it works, how the market around it functions. Things, especially new emerging asset classes, things like cryptocurrency. Our firm has a lot of experience in the SPAC fairness opinion space, understanding the SPAC structure. It's extremely important when you're vetting a firm that you might want to work with to understand what their experience looks like in that space.
And also, obviously, the team expertise and the availability of the team. Everyone is suffering from the resources these days, right? No one has adequate workforce.
Absolutely.
I don't know, people went to the Mars or somewhere so early, you couldn't find anywhere. So it's time for the next polling questions. Okay, most of the people use market approach, which is awesome. Okay, trends in the valuation environment. Right? So I would like to discuss here a bit overall the current market conditions and the macro environment we are going through, Michael. So what's your intake? Do you see lot of valuation percentage decrease in 2022 versus 2021 when interest rates were low and everything is expensive? People can earn 5% on money market accounts. So, and this DCF method and all those will go down. All the growth companies' valuation will go down. What do you see overall valuation between 21 and 22, and what do you see for 2023? How do you think these external factors will play into the valuation here?
Yeah, I think you're right. The overall trend between 21 and 22 is definitely a decline in valuations generally. You cite rising risk-free rates. That's a large component, as well as just a lot of extremely high valuations being thrown around in 21, where there's sort of a cooling effect into 22. I think things sort of calmed down a little bit. Into 23, it's a lot more mixed. It's really dependent on industry and asset class. There's really not, we haven't seen like one particular movement for everything that we've valued. It's, and generally it's pretty mixed, but I think in the 21 to 22 example, there's definitely a downturn of some degree.
Do you think more stabilization in 2023 versus another downward graph?
That's a lot what it feels like. I think there was a lot of, late 22, early 23, especially when we've mentioned the crypto space, post FTX collapse. There was a lot of uncertainty, a lot of risk involved that was understood but not necessarily priced in, and then it kind of all got priced in, and a lot of that had large effects. But I think there is something of a stabilization at current. Even if we see rates continue to rise, the effect on valuations is sort of mixed in a way. It's not like this one-to-one decline as rates continue to tick up. So,
so how do you see overall the M&A market and the funding and the credit spreads are not wide enough? I think funding can be achievable, but still difficult than 2021. But how it would impact your work?
Yeah, funding frequency. We're not having consecutive rounds every 9 months anymore. That's definitely been a big impact for us with our fund clients doing portfolio evaluations, especially in the venture capital space. It was for a while easy enough to mark everything to the last round because the last round only happened 6 months ago. And what's happened now is that we're seeing a lot more where the cash position of the company may be fine and their burn rates may be reasonable, but the last real mark you have, the last transaction was 15, 18 months ago. So it's sort of caused a shift away where you could just mark to transactions for a while pretty consistently. And we've seen a lot of positions for our clients where we've had to shift methodologies as those transactions get further and further away. So, the cooling of that market and the reduced frequency does definitely change how you approach, broader portfolio evaluations.
My question to you is that what if some growth companies value they had lost funding round sometimes in 2021, beginning of 2022, and since then things have changed a lot, right? They don't want to go next round at a lower valuation, right? So that's the reason you think there's a less frequency of capital raising in the secondary market?
Yeah, I think it's down rounds are definitely taboo, right? No one wants to raise at a lower valuation than their last round. So it's a bit of that. And for some, it's a bit of a wait and see approach where their valuation is ticked down from their last round, and with rate increases and just sort of some uncertainty in the broader macro economy, they're sort of biding their time. If they have cash to sit on, trying to see if maybe there's a turn, they can make some progress and valuations will increase. I think there's definitely a component to that for sure, and a little more less of a rush from portfolio companies, or sorry, from venture capital and private equity to use some of the dry powder, sort of a more considered, slower approach on some of these investments.
Why you think they are not deploying too much capital? Because they are are interested in getting 5% on the money market account, or what's the reason they want to deploy?
I mean, I think you could usually outdo 5% in VC, but I think it's just a general. There was a bit of a FOMO moment in 2022. Things were going gangbusters, and everybody needed to get their money in. And now it's sort of back to a more normalized state. Everyone, a little more uncertainty around, and people are sort of taking their time, I think, a little bit more. So, at least from our perspective.
Okay. Is there anything you want to touch on the regulatory side? That because I think one of the point I want to mention here that recently there was private fund advisor rules, and in those rules, SEC requires you to have a third-party valuation must, right? So I'm not sure if this is what you are trying to refer to.
That's what I'm referring to. Yes, there's an audit component to those new rules as well. And then also on advisor directed secondary transactions, advisor-led secondary transactions, they now require a valuation or a fairness opinion. This is work that we specialize in. We've done a lot of it in the SPAC space as well as in non-SPAC space. And it is just additional scrutiny. And I think more than anything, that's kind of been the theme of the last year or so, is both regulatory scrutiny and investor scrutiny. We've seen a lot of firms that, typically would do their valuations in-house and didn't have kind of the pressure to move them to a third-party valuation provider. We've seen a lot of them, reach out to us and ask what we can do for them. So it is sort of a shift in the marketplace that we've observed where funds that, used to be, it was, third party's not going to happen for us, have started considering it just from that increased scrutiny. So.
Yes, I think it's a good thing for you and us both, right? We can do more audits, you can do more valuation, and investors will pay for all of us, right?
Yeah, I think it's good to have the scrutiny. It's good to have some additional pressure on the valuations, right? Make sure everything's tip-top shape.
No, but SEC was doing more to protect the investors' confidence because their job is to put the rules in place so investors can feel safe investing in the companies, and there are checks and balances forcing us to do audit work, forcing you guys to do the third-party valuation. So that these are all the best practices in the industry. But at the same time, emerging managers have very little capital to manage. They may not be able to pay the cost. So only I think big fund managers can absorb this additional cost.
Right, and that's sort of the nice thing too with sort of the span of valuation firms as well, is you'll see everything from big four valuation arms where prices are much higher to smaller independent firms where prices could be lower, more negotiable, maybe more willing to work with you on what the service offering looks like. So when you're, in that position and suddenly now it's a requirement, it's definitely worth looking around, exploring our options, talking to a lot of different firms. Yeah, I think there's some flexibility there.
So would you touch this screen, these Series A, Series B, Series C?
Yeah, we sort of touched on this. It's just making it clear, that the additional time between funding rounds causes valuation complications, makes the methodology more involved, and frequently requires that you go back to portfolio companies and try to push for additional information on a more frequent basis. If you were just marking to funding rounds, you could just get your little closing packet and pass it on to your valuation team and they could mark it to the close. That's not as much the case anymore. So there is that additional regularity of touching base with portfolio companies from a valuation perspective that has definitely ticked up in the last 12 months or so.
Good to know. So we have already touched the interest-free rate, so I think there's no, everyone knows. Savers, this is a savers time. Savers are getting first time paid on their extra cash. They can earn some money. Before saver was being penalized by not saving. So I think, I'm not sure how long this will continue, but it's a good time to enjoy it and earn some 5% interest on the money market. Okay, information, I think we have already touched that. So it's a third polling question, after that fourth, and we can wrap this up and conclude this session. It's quite easily. Okay, before we do, I have another polling question. Fourth, so if you were not able to answer, please answer this so you can get the CPE, and our team will send you the CPE certificate. So this will be very easy questions. Are you listening or not? So hopefully you're listening and will get your CPE certificate. Okay, Michael, I think we have a couple of minutes left before we conclude. What would be the key takeaway from this? What would you recommend the fund managers, venture capital, private equity here, if they are on the call? That what would you tell them that what they should get from this webinar?
Yeah, I think the key takeaway here is the regulatory environment's changing, the level of scrutiny is changing. It's a good time to re-examine your valuation policy. Think about what you're going through process-wise. Think about how often you're doing it. Think about whether or not to use a third-party firm. Again, as I mentioned, we've seen a lot of folks shifting towards the third-party option. And that's really the takeaway. It's not something you always think about. You're busy out there making investments. Might have an internal team that does it every quarter, but it's worth touching base, worth re-examining.
Absolutely. I would say thank you, Michael, for your sharing your wonderful thoughts and educating me and all the attendees. So stay in touch. We will definitely send you your CP certificate. And once again, thank you, Michael. I appreciate it.
Thanks.